So let us continue with depreciation. Question number 1. We will move to the second sub-question. Okay. The second sub-question, that was, what was it asked? Prepare machinery account, depreciation account, and provision for depreciation account for the first 4 years by providing depreciation using straight line method. Here also the method is straight line method. Let us see the journal entries. Yes. Journal entry is, what is the first journal entry? Depreciation account debtor, provision for depreciation account. That is the first journal entry. Next one is profit and loss account debtor to depreciation. Okay. So do you find anything related to asset here? Is there any change taking place to asset? No, we are not charging this depreciation to the asset. So the value of asset remains the same. In the earlier case, the depreciation, we were charging it to the asset. We were showing it as deduction from the value of asset. But in this method, we are opening a new account, which is provision for depreciation account. So prepare the machinery account, please. There is no change. When the machinery is purchased, machinery account debtor to bank, 3 lakh. At the end of that year, again, the rate, the value remains the same. Nothing is there on the credit side. Okay, I'll show you that. How is that balancing figure coming there? Listen, listen. See, this is the T account. Okay, machinery account this is. Okay, so debit side, credit side. Machinery account debtor to bank. What is this? Machinery purchased, 3 lakh rupees. Finish. We are not recording anything else. So, is there anything on the credit side? Nothing. It is 0. Correct? There is nothing. It is empty. So, balance it. Balancing is done the usual normal way. 3 lakh, 3 lakh. So, here it is 0. So, what happens? Balancing figure will be 3 lakh itself. 3 lakh. This 3 lakh will come to the next year, brought down. So this is balance carried down, and it is carried down. So here balance brought down, BD, brought down. That will be again 3 lakh. Now nothing is there over here, again 0. Balance it. Again you will have 3 lakh itself. So please do it for 4 years of time. We are asked to prepare machinery account for 4 years. What happened, Alan, in the previous hour?
Ma'am, network.
Okay. So this is the machinery account. The first journal entry is machinery account debtor to bank or cash. Machinery account is debited. Come to the debit side and write to bank. 3 lakh. Okay, that is taking place on April 1st. April 1st, accounting period starting from April 1st and it ends up on March 31st. Then we are going to write this journal entry. We are going to charge depreciation. At the end of the year, what happened? Continuously using this asset, using this machine, the value will come down. How much? That is this depreciation. Depreciation account debtor to machinery. So what is happening in machinery? Machinery is credited. Credited. So come to the credit side and write by depreciation. By depreciation. 28,000. Okay, 28,000. Finish, nothing else. Then what to do? Balance it. Balance it. 3 lakh is higher. Write the total on both the sides. Here we have only 28,000. So 30 lakh, sorry, 3 lakh minus 28,000 gives 2 lakh 72,000. So this means that machinery was purchased for 3 lakh. By the end of first year, what is the value of machinery? When you sell it, or if you have planned to sell it, you will not get this 3 lakh. You will get only this 2,72,000. By the end of first year, value of machinery has come down to 2,72,000. Keep the videos on. Finish. So balance carried down. This balancing figure will bring it to the next year. Okay. And the process continues. Depreciation is 28,000 itself. Why? Why? Why is it 28,000? Because it is straight line method. Depreciation remains constant. Okay? And what happens to the value of asset? Value of asset decreases. See? This process continues. Balance carry down, coming here. Balance carry down, coming here. You are asked to prepare only for 4 years. That's why we stopped with 2013-14. 2010, 11, 12, 13. 4 years. Okay. So see, at the end of 4th year, see the value of machinery? We purchased it for 3 lakh. But now, at the end of 4th year, it is only 1,88,000. Okay. Now, this is about the machinery account. Next is, we need to prepare depreciation account. Based on the journal entry, you will do that. That's it. First entry was depreciation account debtor to machinery. Next one was, the second entry was P&L account debtor to depreciation. Yes, that's it. It is the depreciation account. Now, what is depreciation account done in the first entry? It is debited. Come to the debit side. What do you write? Machinery. To machinery. Okay. See the next entry. P&L account debtor to depreciation. So depreciation account is credited. Depreciation account credited. Come to the credit side of depreciation account. What will you write there? Write by profit and loss account. Those who missed the class, are you okay now? Did you get the idea?
Yes, ma'am.
Yes. Now I'll send the file today itself in the group. So this was sub question A. Now the second question, the second part. Here we are doing this, the second method. What was that? Creating provision for depreciation. It is based on this. We are going to prepare what? The accounts. Machinery, depreciation, provision for depreciation. So here the journal entries are depreciation account debtor to provision for depreciation. This is the first entry. Second one remains the same as the earlier one. Profit and loss account debtor to depreciation. So here we are not doing anything with the machinery account. In the earlier case, We were charging depreciation to the machinery. See, charging depreciation to the asset account, machinery. We were reducing this depreciation from the machinery. But in the second case, we are not doing anything with the asset account. Instead of that, we are opening a new account. New account. And what is that called? Provision for depreciation account. Understood? Is that clear? In the earlier case, what was the journal entry? Depreciation account debtor to asset. So that time from the asset account, we were reducing this depreciation. But here, we are not doing anything with the assets. Instead of that, we have opened a new account, that is provision for depreciation. But in the question, they have asked to prepare machinery account. Machinery account, depreciation account, also provision for depreciation account. They have asked us to create or prepare all these three accounts. So according to the sub question B, we don't have anything to do in the machinery. Machinery was purchased for 3 lakh. Okay, we are not charging depreciation. The value remains the same. That depreciated amount, we are keeping it in another account. We are not deducting from the assets. Okay, we are not deducting depreciation from the asset. Instead of that, we are making or putting it in another account. That is provision for depreciation account. So here, value of machinery will not change. See, so 3 lakh rupees. There is no other amount there. Balancing figure will be the same. That is brought down to the next year. Again, nothing is there. 0. Balancing figure is 3 lakh. Coming down. Again, coming down. Finish. So throughout the 10 years, 10 years is the expected life. Okay? Here in the question, we are asked to prepare only for 4 years. That's why we stop here. Okay. So this is about the machinery account. I hope now it's clear. You get some idea. Now let's see. Okay. Provision for depreciation account. How to prepare provision for depreciation account? What is the journal entry? Alan Shibu, tell me what is the journal entry? The second method, first journal entry. Opening provision for depreciation account.
Ma'am, depreciation account debtor to provision of depreciation.
Very good. Okay. Depreciation account debtor to provision. Provision for depreciation. Okay. Provision for depreciation. Now, we are asked to prepare provision for depreciation. What is provision for depreciation done in the journal entry? Is it debited or credited?
Credited.
It is credited. To depreciation means credited. Okay, it is credited. So this is the provision for depreciation. This is provision for depreciation. Provision for depreciation is credited. Credited. By what? By depreciation. Okay? By depreciation. Depreciation account debtor to provision for depreciation. Provision for depreciation account is credited. Come to the credit side of provision for depreciation. So whatever is there on the top, you will write here. By depreciation 28,000. Now, that's all. Same like the earlier case with machinery. We don't have anything else to be recorded. So here nothing is there, 0. We have written the amount 28,000 here. Depreciation 28,000. Balance it. So balancing figure will come here. Not okay? Provision for depreciation account. By depreciation, here is the amount 28,000. Nothing is there, nothing. Balance it. So here you have 28,000. Here you have 28,000. What is here on the debit side? Nothing, 0. 0. So 0 minus 28, 28,000. This is the balancing figure. Balancing figure. So balance carried down 28,000. This is this 28,000. Now this balancing figure from here, you bring it here. Next year. Transfer it to the next year. Okay, the same continues now up to 4 years. Balancing figure 28,000. Now the next year, again the depreciation. Next year depreciation 28,000. We are keeping this depreciation amount in another account. So first year we have 28,000. Again next year another 28,000 has come. Every year we have to charge depreciation. Every year the asset value is decreasing. So in the second year also, value of asset decreases by 28,000. Okay, so now what happened? We have two amounts here. Nothing is there here, 0. Add this to 56,000. Balancing figure comes here, 56,000. Bring this 56,000 here. Again, in the third year, you are charging depreciation. $28,000 is charged. Together, it becomes 84,000. This 84,000, nothing is here. So balancing figure, 84,000. Bring this to the next year. We are asked to prepare it for the 4 years. So we stop here. So till 4 years, up to 4 years, depreciation is 1,12,000. Yes, Pranav? It's okay. Take some time, think.